You know that feeling. You're trying to get your head around something complex, maybe like options trading, and you pull up this screen, charts, numbers, just rows and rows of data, and your brain just freezes,
Yeah.
completely overwhelmed, like you're drowning before you've even figured out how to swim.
Oh, yeah. That's super common,
Yeah,
especially with financial data. There's just so much of it, and it's always changing. Finding the signal in the noise,
that makes
that's the real challenge.
absolutely. And well, that's kind of what we're doing here today. We've taken this specific source, a YouTube video transcript, actually, that's designed to help beginners really understand the option chain. And we're going deep on just that source.
Yeah, think of us as guides for this particular map. We're going to pull out the most critical bits, the core ideas, and the practical steps that this video suggests are really key to making sense of it all.
Right. So this deep dive, it's really for you. Maybe you're looking at markets, prepping for a discussion, maybe just curious about how these tools are actually used. We want to help cut through some of that initial confusion.
hmm So, our mission today: unpack what the option chain is, how this source says you should read it, and, crucially, how it suggests using it to maybe spot the market's likely range and direction. The goal they talk about is helping newer traders. They mention that 18 to 25 group specifically to potentially, reduce some of those early losses and maybe find better opportunity.
And hopefully deliver a few aha moments along the way, not just list off facts. Let's dive in.
Okay, let's start right at square one, just like the source does. What is an option? Fundamentally, it's a financial contract, a derivative specifically. Its value comes from something else, like a stock price or an index level.
Okay, simple enough.
Mm.
And the two main flavors everyone hears about are call options and put options.
Exactly. And the source lays out the basic viewpoints pretty clearly, depending if you're buying or selling.
Mhm.
If you buy a call option, you're generally bullish. You think the market or the stock is going up. You're buying the right to buy it at a set price later on.
Right. I buy a call because I think the price will go higher than that set price.
Precisely. Now, flip that. If you sell a call option, you've got the opposite view. The seller of a call generally expects the market to go down or, at least stay below the price they sold the call at. They're taking on the obligation to potentially sell at that price.
Got it. Call buyer equals bullish. Call seller is bearish. How about puts?
So the buyer of a put option is bearish. They expect the market to head down. They're buying the right to sell at a specific price.
And the put seller.
Completes the picture. The put seller is generally bullish. They expect the market to go up or at least stay above the strike price they sold the put at. They're taking on the obligation to potentially buy at that price. Understanding these four basic stances is really the bedrock before looking at the data itself.
Okay, now the source brings up something interesting about the type of options commonly traded, especially in markets like India. It affects how you interpret things later. European versus American options.
Yeah, it mentions that historically you might have seen American-style contracts, CA, PA, but what's mostly used now, especially for indices there, are European-style CE, PE.
Okay, bit of history, but why does that difference, American versus European, actually matter when we're staring at an option chain today?
It's actually pretty crucial because of when they can be exercised. American contracts gave the buyer a lot more power. They could exercise the option anytime before it expired. If the price moved their way, bang, they could cash in.
So the buyer had that flexibility.
Right.
And European?
European options can only be exercised on the actual expiry day. That's it. And this really shifts the advantage towards the seller. The seller knows they only have to worry about that one specific day, not getting exercised early if the market moves against them temporarily.
Okay. So when we start looking at those big positions on the chain, especially the sellers, this European contract thing is key context from the source. It explains why those sellers might hold so much sway.
Exactly. It's foundational for how the source interprets open interest later on.
All right, let's picture navigating to the NSE option chain website like the source suggests. You just search for it online. What hits you first?
You land on this pretty structured interface. First off, you can pick the expiry date, often weekly for the big indices like Nifty and Bank Nifty, monthly for individual stocks. And you can switch between, say, Nifty and Bank Nifty easily.
And then you see the main grid, which honestly can look a bit like a spreadsheet exploded.
It is a lot of data, but it's organized. You'll typically see call options on one side, usually the left, and put options on the other, the right. And right down the middle, that's the strike price column, the specific price levels for the contracts. The source mentions Nifty strikes are usually in 50-point steps.
And flanking those strikes, all these columns, OI, change in OI, volume 4, LTP.
Yep. Open interest, change in open interest, volume traded that day. IV, which is implied volatility. LTP, last traded price, that's the options premium.
Hmm.
Change in premium, bid price, bid quantity, ask quantity. It definitely feels overwhelming at first glance.
The source does give a handy tip here for beginners choosing between Nifty and Bank Nifty, right?
Yes, it strongly suggests starting with Nifty analysis. Even though Bank Nifty has a smaller lot size, 25 shares versus Nifty's 50, Bank Nifty is known to be way more volatile. The swings can be much bigger, much faster, so the source advises that Nifty is maybe a less risky place to start learning this analysis despite the larger lot size.
Good advice. Helps manage that initial shock. So, okay, we're looking at all these numbers, especially that LTP, the premium, the price of the option. The source emphasizes this premium isn't just one thing. It's made of two separate components.
This is a really fundamental concept to grasp, that premium is made up of intrinsic value and time value. But to get that, you first need to know about ATM, ITM, and OTM strikes, at the money, in the money, and out of the money, all relative to the current market price, the spot price.
Okay, ATM, ITM, OTM.
Right, ATM is simple. It's the strike price closest to where the market's trading right now. So if Nifty's at, say, 16,350, the 16,350 strike is at the money.
Makes sense. And ITM and OTM, they flip depending on if it's a call or put, right? That trips people up.
It really can. So for call options, remember, ITM strikes are below the current spot price. The market is already in the money compared to that lower strike. OTM call strikes are above the spot price. The market needs to climb up to reach them.
Got it. Calls. ITM is lower strikes. OTM is higher strikes.
Perfect. Now for put options, just reverse it. ITM put strikes are above the current spot price. The market's already fallen below that higher strike. OTM put strikes are below the spot price. The market needs to fall further down to get there.
And the source uses that really visual analogy when you look at the NSE website.
The butter analogy.
Yeah.
Yeah, it points out how ITM strikes are often highlighted, maybe in yellow, while OTM are plain white. The idea is yellow is like butter extracted from milk. It's the richer, more valuable part already there.
So yellow butter, ITM, what is more valuable, higher premium. White milk, OTM. Less valuable, cheaper premium. That definitely helps it stick.
It really does. And that visual difference is directly tied to the concept of intrinsic value. Intrinsic value is the actual real value an option already has based on where the market price is relative to the strike price.
How do we calculate it?
For a call option, it's simply spot price minus strike price. If that's a positive number, that's your intrinsic value. If it's 0 or negative, the intrinsic value is 0. The source uses the example. Nifty at 16,350, you're looking at the 16,000 strike call. Intrinsic value of 16,350, 16,000 will yield 350.
Okay. And for puts?
For puts, it's strike price minus spot price. Again, if it's positive, that's the intrinsic value. If 0 or negative, intrinsic value is 0.
Right. So intrinsic value is the real part based on the current price. If the total premium, the LTP, for that 16,000 call was, say, 401, and the intrinsic value is 350.
Then the rest, that's the time value. It's just premium minus intrinsic value. So in that case, 401, 350 is 51. That 51 points is time value.
And this time value, it sort of melts away, doesn't it?
That is the crucial point about expiry. OTM options, remember, they start with 0 intrinsic value. Their entire premium is just time value. If they stay OTM until expiry, poof, that time value decays completely to 0. The option expires worthless. ITM options do have intrinsic value. They keep that value at expiry. It's only the time value part that decays away. That's theta decay in action.
So understanding intrinsic versus time and ITM versus OTM is absolutely critical. It tells you what you're paying for and what part is guaranteed to disappear by expiry if the market doesn't move your way.
Exactly. It explains why options lose value as time passes, especially the OTM ones.
Okay, structure down, price components down. Now let's get to the juicy part. Using this data to figure out where the market might be headed, the source suggests using open interest, OI, to find the market's likely range.
Yes, open interest. That number just represents the total count of contracts for a specific strike that are still open, not yet closed or expired. And the source makes a really strong point. The players with the serious money, the institutions moving thousands of crores, as they put it, they argue these players are primarily sellers of options, especially because of that European-style advantage we talked about. They have a massive financial stake in making sure the market doesn't move too far against their sold positions.
So where we see the highest open interest on the chain, that's basically where these big players have drawn their lines in the sand.
That's the core idea presented. Those huge OI numbers at certain strikes act like, well, invisible walls, eventual boundaries for the market's movement.
How do we use that to actually find support and resistance levels then?
You scan the call side and the put side, focusing around the current market price. The source suggests maybe looking about 8 strikes up and 8 strikes down from the at-the-money strike.
Okay, let's start with resistance to ceiling.
For resistance, you look at the call side data. Find the strike price that has a significantly large open interest number. The theory is the sellers of all those calls at that strike don't want the price to go above it. They form a major resistance barrier. The source gave examples like seeing, say, 114,000 lots of OI at the 16,500 call strike, or maybe even higher at 16,800. Those act as potential ceilings.
Right, so those big call sellers are effectively betting the price probably won't get past here.
Exactly. They've committed capital to that view. Now, for support the floor, you look at the put side. Find the strike price on the put side with a really big OI number. The sellers of those puts want the price to stay above that level. The source highlighted an example like the 16,000 put strike having a massive 179,000 lots of OI, suggesting very strong support there.
So the big put sellers are defending 16,000, effectively saying, we think the market stays above this level.
Precisely. So by spotting these high OI strikes, the big call OI for resistance, the big put OI for support, you can, according to the source, define a likely trading range for the day. Like in their example, maybe the market is expected to stay between 16,000 and 16,500.
And knowing that potential range,
Yeah.
that's really valuable for certain strategies, isn't it?
Oh, yeah. If you think the market's going to be stuck in a range, strategies like selling straddles or setting up butterflies or iron condors, they become much more informed plays if you have this OI-based range estimate.
Okay, OI helps define the playground boundaries, the range.
Yeah.
But what about the direction within that playground? Is the market likely to lean upwards, downwards, or just kind of bounce around sideways?
For that directional bias, the source introduces the put-call ratio, the PCR.
How's it calculated? It sounds simple, but the source had a specific twist.
Yeah, they really emphasize using the change in open interest for the day, not the total OI figure we use for range. And again, focus on the relevant strikes around the current price. The calculation is total change in OI on the put side divided by total change in OI on the call side for those selected strikes.
Got it. Change in put OI divided by change in call OI. And they mentioned sometimes you see shares, not lots, so you might need to divide by the lot size, like 50 for Nifty, to compare apples to apples.
That's correct. And then it's all about interpreting that ratio. According to the source's framework, a PCR value greater than 1.5 is seen as bullish. More put activity relative to calls suggests stronger underlying support or buying interest. A PCR less than 1 suggests bearish sentiment, or maybe just less bullishness, more call activity relative to puts.
What about really high or low readings?
Yeah, they give extremes too. A PCR above 4, that's considered extremely bullish, maybe hinting at a sharp upward move. On the flip side, a PCR below 0.2 is seen as heavy bearish, suggesting a high chance of a significant drop.
And right in the middle, around 1.
If the PCR is hovering around 1, maybe between 0.9 and 1.2 roughly, that points towards a sideways market. Buyers and sellers are more balanced. Now, the source makes a pretty bold claim here. They suggest this PCR analysis, based on tracking those influential seller actions, gives you about a 70% probability of gauging the market's direction correctly.
70%. Wow, that's quite an edge over just guessing.
Hmm.
But hang on, calculating the change in OI manually across multiple strikes and doing it every 5 minutes as the data updates.
Yeah.
That sounds like a full-time job.
It absolutely would be tedious, and this complexity leads the source directly into some really crucial trading rules. Rules that combine this analysis with practical timing and entry.
Rule number 1 really stood out. Never trade before 11 a.m. Why is that?
The reasoning given is interesting. They say the early morning session, say the first hour or so, is often dominated by maybe less experienced traders, amateurs reacting to overnight news. Noise, essentially. The professionals, the big money, tend to let things settle, see how the market digests the open, and then start positioning themselves more seriously later in the morning. So you need to let that meaningful change in OI data actually build up before your PCR calculation is reliable. The source suggests waiting until after 10:30 a.m., ideally closer to 11 a.m., to even start relying on these indicators.
So that first 90 minutes is often just churning. Let the dust settle and see where the real players are leaning.
That's the principle they put forward. Let the data mature. And rule number 2 is just as critical. It's about where you consider entering a trade, even if your PCR signal looks good. Only take an entry near VWAP.
VWAP. Volume weighted average price. I've seen that line on charts. What is it exactly, and why is getting in near it so important?
So VWAP is basically an average price for the day, but it's weighted by trading volume. Prices where lots of shares changed hands have more influence on the VWAP line than prices with little activity. You usually see it plotted on futures charts like Nifty futures or Bank Nifty futures. And the source observes that the market price tends to sort of gravitate towards or bounce off this VWAP line throughout the day.
Okay, so what's the benefit of entering near that line?
Risk management, mainly. If you enter a trade when the current price is close to the VWAP, your potential stop loss can usually be placed tighter, closer to your entry. If you jump in when the price is stretched really far away from VWAP and then it snaps back towards that average, which it often does, your potential loss could be much larger.
Ah, so it's about finding a point of equilibrium, a lower risk entry point. You need both things aligned. The directional signal from PCR and the price needs to be near VWAP.
That's the combination the source insists on. If your PCR looks great, say strongly bullish, but the price is miles above the VWAP line, the rule is don't chase it, don't enter. It echoes that famous Warren Buffett principle. Rule number 1, never lose money. Rule number 2, don't forget rule number 1, entering far from VWAP increases the risk of breaking rule number 1.
That really adds a layer of discipline, doesn't it? It's not just predict the direction, it's predict the direction and find a sensible, low-risk spot to act on it.
Precisely. It connects the probabilistic analysis from the option chain data with a practical, risk-aware execution strategy.
Okay, one last piece of data from the chain the source brings in. Implied volatility, or 5E. What role does that play?
5E is another key input. In simple terms, it reflects the market's expectation of how much the price is likely to swing around in the near future. Volatility expectation. The source uses a good example. Imagine some sudden big news hits. Even before the price reacts much, the anxiety or expectation of future swings goes up. That's IV increasing.
So IV is like the market's fear gauge or excitement gauge about future price movement.
That's a great way to put it, yeah. And higher IV directly translates into more expensive option premiums. People demand more money to sell options if they think there's a higher chance of big, sharp moves.
So how does the source suggest we use this IV reading in our trading decisions?
The logic presented is fairly straightforward. When 5E is high, options are expensive. The source actually says it's smart to sell options then because you're collecting that inflated premium. And conversely, maybe stupid to buy calls because you're overpaying. So high IV might favor strategies like selling puts, for example, if your directional view allows.
And if 5E is low?
When phi is low, options are relatively cheap. This, according to the source, might be a better time to consider buying options like calls because you're paying less premium for that potential upside movement.
And they even provided some rough benchmark numbers for context, didn't they? Like what counts as high or low IV?
Yes, they gave some general guidelines based on the overall market condition. In a bull market, maybe IV over 21 is high, under 15 is low. In a bear market, the levels are higher. Maybe IV over 38 is high, under 21 is low. And in a sideways market, which they felt was common, maybe IV over 20 is high and under 12 is low. These just give you a rough feel for whether the current 5E is elevated or depressed.
Okay, so IV adds another filter. Is the insurance premium for price moves currently expensive or cheap? That helps refine the decision based on the source's framework.
Exactly. It helps you decide whether the current market pricing for volatility makes buying or selling options more attractive at that moment.
Wow. Okay, that was quite a journey. We went from the absolute basics of what an option is, navigated that potentially intimidating NSE option chain layout.
Yeah, broke down the premium into its intrinsic value, the butter, and its time value that decays away.
And then got into the core application. How this source suggests using open interest to map out that potential market range, using the put-call ratio to get a directional hint, and layering on those crucial timing rules, waiting past 11 a.m., entering near VWAP for risk management.
Right. Plus, factoring in implied volatility to gauge whether options themselves seem cheap or expensive based on market expectations.
It really provides a structured way to approach the market using the data that's right there on the chain. And while, nothing's guaranteed in trading, the source presents this as a method that's data-driven, potentially offering that higher probability edge they claimed, around 70% for direction, compared to just, shooting in the dark.
Yeah.
It feels like it's about taking back some control, making more informed choices based on what the data might be showing.
It offers a pathway through the initial overwhelm, a method to actually use the numbers instead of just being intimidated by them.
So as we wrap up this deep dive, here's something to think about. If those huge open interest numbers really do represent billions of dollars from major players defending certain price levels, what does that truly imply about the sort of hidden forces shaping the market's day-to-day movements? And how might simply learning to read where those forces seem to be concentrated as this source suggests, allow you to potentially align your trades with those powerful currents instead of fighting against them.
Yeah, it shifts the focus a bit, less about perfectly predicting the future, more about understanding the current battlefield laid out by the biggest players.
Exactly. So we really encourage you to take these ideas, maybe pull up an option chain yourself when the market's open, and just watch. See if you can spot these patterns the source talks about. That's all for this deep dive. Go explore.